Everyone, Clint Lee here, research analyst for the Bauman Letter and editor of Flashpoint Fortunes. Ted is out today, so today I will be bringing you your Bauman Daily Friday video. But before we get started, if you want to learn more about my Flashpoint Fortunes options trading service, just click the link in my top left on the top right corner of your screen. This is where I'm taking a quantitative model I developed and combining it with a technical system to pinpoint opportunities. So once again, just click on the link above to learn more about that. So no matter whether you're an options trader or an investor, this week you had a lot to contend with. This week we had over a third of the S&P 500 reporting earnings. That is still ongoing. But then we also had some key developments around the Federal Reserve as well as with the infrastructure bill. And so those are the two events I want to talk about because it's impacting an area of the market that I think is very important to monitor for clues as to whether or not we see this rally continue or we start to roll over. And we're starting to see these last couple of days, these events really starting to impact this corner of the market. So I'll get to that in just a moment. First, let's talk about the Fed. All eyes were on the Fed and their plans for tapering, or what they were going to say about tapering. So just we've had this low rate environment, interest rates being held at zero, but at the same time, via quantitative easing, the Fed has been creating $120 billion in money a month to buy government securities, whether it's Treasury securities and mortgage-backed securities. And just to frame up how much QE has been done, how much is out there right now, I just want to show you a chart real quick of the Fed's balance sheet. So the balance sheet is just one way that we can track how much QE has been done up to this point, because when the Fed creates money and buys a security, that becomes an asset, hence why we can track the Fed's balance sheet assets here. Now, I took this back all the way back to the financial crisis, just to show you the big picture of kind of where we've been and how much QE has been done just over the last year or so. So the Fed's balance sheet now stands at over $8 trillion. Over $8 trillion. That is over 2 times what the balance sheet was just before the pandemic, going into the pandemic. So just to give you a sense of the size and the scale of this program and how important it is, and why investors and economists are watching so closely for any clues as to when this is going to end. And we got that clue during the Fed meeting this week. Now, one of the things that investors, economists will do, and myself included, is parse over every single word, whether spoken by Fed Chair Powell or in their statement. And it's their statement that contained a bit of a dovish surprise. So I want to show you a sentence from their statement to highlight what I mean. So they're talking about their employment and price stability goals, and they go on to say, since then, the economy has made progress toward these goals, and the committee will continue to assess progress in coming meetings. That one letter in that sentence was a bit of a dovish surprise for the markets, that they are coming out and saying that they're going to monitor progress over coming meetings, plural, suggests that we're still a little ways off before a taper begins. Now, there was speculation that we were going to see the plans, the details to start winding down the bond buying program come out next month during their annual symposium at Jackson Hole. This makes it kind of somewhat clearer now that not to expect that next month. That it's probably really not going to be more until, say, November or December until we start to see that wind down of the balance sheet, or at least the details around that. So that's being pushed out. That was a dovish surprise. It's Thursday as I'm recording this. We're seeing the markets respond favorably the day after that Fed meeting. Now, during the press conference, Powell was very, very confident, was projecting a lot of confidence about the economy continuing to improve, that they're going to hit their goals there. But I mean, I have to speculate that at least privately, they're worried about at least one chart, thing that's going on that could impact the economy, and that's with the COVID case count. So here's a chart of new COVID cases from the New York Times. You can see on the right-hand side of the chart here, we're starting to see another quick escalation in case counts. We know the Delta variant is making its way around. It's more contagious. And so what does that mean We're starting to see the mask mandates come back into play. The big unknown is how this alters consumer behavior. There's this expectation that you've got all this pent-up demand that was going to be unleashed on the economy, especially as the case counts were just dwindling in the summer months. We're seeing that reverse. So that presents a big element of uncertainty going forward. I think you're seeing that reflected with the Fed's statement here, that they don't want to move too quickly with that still being out there. Now, the other thing, big event that happened this week was with the infrastructure bill. Now, we are still a long ways from having a finalized bipartisan infrastructure bill, but we took a big step this week. So just as a reminder, a refresher, there is a $1.2 trillion bipartisan package that was worked on by both Democrat and Republican senators. That includes about $500 billion in new federal spending. And this week, it passed a procedural vote. They got enough, all the Democrats voted yes, there was enough Republican votes to pass on a procedural vote. All that really does is just, it opens up the bill for debate and to be amended and finalized, so you can have a finalized piece of legislation that then goes on to another vote, has to be passed in both the Senate and the House. But the fact that you had enough Republicans come on board, at least, is a good sign here initially. But the bigger picture, too, is with another follow-up spending package that the Democrats want to do. And what they want to do is use the budget reconciliation maneuver to pass another $3.5 trillion spending package. And here's why I bring all this up, is because Democratic Senator Joe Manchin is just a key part in this plan to use budget reconciliation, because he said earlier this week that if they could not pass the bipartisan bill, then everything could be off the table. It could wreck everything, signaling that he might not get on board for this follow-up $3.5 trillion spending package. Now, the way this budget reconciliation process works is that you only need a simple majority to pass that spending bill. But in order to do so, Democrats need every single vote that they have, and Manchin was making it clear that if the bipartisan bill did not go through, that this follow-up spending package could be in jeopardy here as well. So, not only do we get a step closer to a bipartisan bill, the infrastructure spending is kind of the heart of infrastructure, but it keeps this bigger $3.5 trillion package on the table. So, okay, what does all that mean? What that means is that we are finally starting to see some signs of life in a part of the market that has been lagging badly. So between the infrastructure spending, more stimulus from the Fed, we have seen small cap stocks. Small caps are starting to perk up these last couple of days. And that's important because I want to show you a chart right here of the small cap ETF. This is ticker IWM. And really, I mean, going back to about January or February, we have just been in this sideways trading range. We've been in this extended consolidation range. I'm showing that with the green box on here. And if you start to look toward the right-hand side of the chart, just the other week, it looked like we were going to threaten to break out below the bottom end of this box on here. We came down and came close to testing that green line. That's a 200-day moving average. With how badly small cap, in the meantime, large caps have been taking off, right? I mean, a lot of the mega cap tech names are driving the S&P 500 higher. Meanwhile, this has not been able to break out. And that's been causing a lot of deterioration in some of the breadth metrics of the market, such that if we were to break out of the bottom end of this range, that spells trouble for the rest of the market, versus if we can break out above this box on here, we can start to improve those metrics and get these other areas of the market kicking into high gear as well. We can sustain the advance here. And just over the last couple of days, as I'm recording this, we've tacked on a couple percent to this ETF, to small caps. The news around the Fed, but then the prospects with these infrastructure bills, all that spending domestically, and how small caps are levered to the domestic economy, That's why this week has been so important. We're starting to see small caps turn higher. We've come back up. We're testing that 50-day moving average. If we want to see this advance in stocks be sustained, we need to see this ETF break out of the high end of this range. And that would be a signal to me to get more aggressive in adding positions that you've been looking at. On the flip side, if we were to roll over and break through the bottom end of this range and fall through that 200-day moving average, I would expect the rest of the market to catch down here. So this is one thing one ETF to keep an eye on very closely, and how these events of this week are impacting what it's doing inside this trading range. Once again, if you want to learn more about Flashpoint Fortunes, our options trading service, and how I use information like this to make trading decisions, just click in the link in my top left, the top right of your screen. And that is all I have for you today. Thanks for watching.